Welcome to Investment and Pass-Through Income Reporting Requirements, including FBAR and FATCA. Talking about interest and dividend income used to be pretty straightforward. We'd talk about interest income, we'd talk about dividend income, the common things you needed to know, and we were done with that matter. But over the past few years, increased scrutiny by the federal government on overseas investments has created a whole new area of complexity and increasing complexity for individuals who have financial accounts outside this country. So about half of our class is going to be devoted just to FATCA and FBAR and some of the streamlined compliance programs that have come into being. Then we'll spend the other part of class actually looking at the mundane business of reporting interest and dividend income and the rules around it. Got various different sources that you can click on here to go read more. In particular, pay attention to this IRS website page on streamlined filing compliance procedures. I can tell you right now, because this school is located inside of the United States and most of the clients that I'm dealing with are U.S. residents, and probably is the case for you guys as well who are attending my class, I'm really going to focus on the streamlined compliance procedures that apply to U.S. residents. There are also streamlined compliance procedures for people who are residing outside of the United States, and I will mention those, but I'm not going to go into the specifics of them. But if you click the link here in the manual, it will take you to the IRS website where you can then select between resident compliance issues and non-resident compliance issues. And if you are outside of the United States, you have different rules you follow than if you are inside the United States on those. And then moving on down to the first page of the manual, actually technically page 2. We're starting off with the definition of investment income. And investment income generally includes interest, dividends, as well as royalties, annuities, and short-term capital gains. But today's class is really only going to focus on the filing requirements for dividend income and interest income reporting only. We're not going to be getting into those other types of income such as royalties and capital gains because those are reserved for other sessions. However, this class will get a little bit into the pass-through income reporting when you get a K-1. Very elementary beginning levels of pass-through reporting and how that works. Let's take a look at the Schedule B, which in and of itself is not a terribly exciting form. It doesn't have very many lines. So many of tax forms out there are multiple pages with 30, 50 lines on them that you have to sort through. But Schedule B is quite simple by comparison. It has only a small number of lines, but they've managed to make it complex enough with all of the other things you have to stay on top of that maybe there isn't a line for on the form. Depending on the amount of interest and dividend income you have, you may be able to report your interest or dividend income directly on the 1040 form, or it could be the case that you're required to attach a Schedule B. And I have here a list of the reasons why you would be required to file a Schedule B. And the first one is that your taxable interest or ordinary dividend income is more than $1,500. Or you were excluding interest under the Education Savings Bond Program, or you had a foreign bank account or trust, or a homeowner paid you interest under a seller-financed mortgage, or you received Form 1099 INT for U.S. savings bond interest for amounts that were reported before 2014, or you received nominee interest or ordinary dividends for someone else, or you received a Form 1099 INT for interest on frozen deposits, or a 1099 INT was issued to you for interest on a bond that you bought between interest payment dates, or you were reporting original issue discount or OID in an amount less than the amount shown on Form 1099 OID, and finally you acquired taxable bonds after 1987 and chose to reduce the interest income from the bonds by any amortizable bond premium. So if any of those applies to you, you are required to attach Schedule B, and if none of them apply to you, you can enter your interest directly on 1040. Now, most filers who report interest and dividend income are not required to attach the Schedule B, but I'm finding over the years that the number of filers I have who are required to file Schedule B has been increasing. Either our business is changing or Something's changing that's causing this to happen, but we're doing it quite a bit now. Complete Part 3 of Schedule B if you have ownership or interest in a foreign financial account, and if your financial accounts also totaled $10,000 or more at any time during the year, then you would be required to file FinCEN Form 114, Report of Foreign Bank and Financial Accounts. This is the 1099-B, and as I explained, it actually doesn't have that many lines, although on each line, like line 1, there's a lot of lines. And of course, that's how you list, or that provides space to list all of the different payors of interest. And then on line 3, you can see excludable interest on Series EE and I U.S. savings bonds issued after 1989. You attach Form 8815 if you received interest from savings bonds and then you spent it on qualifying education, then you can exclude that amount on line 3. Line 5 is where you list all the payers of dividends, and line 6 is, of course, where you total those up. Now, the part of the Schedule B that I wanted to draw your attention to is this Part 3 where it says foreign accounts and trusts. This is an increasingly important area, or has been an area, we could say, of increased scrutiny for some time now. And even if your client had only $10 of interest for the year, and that interest came from a foreign account, and they can show that that foreign account had, or a combination of their foreign financial accounts, totaled $10,000 or more at any time during the year, then they're going to need to file FBAR, but also you're going to have to check the box that says, yes, I have interest in a foreign financial account, even if the amount in that account is only, say, $1,000. Let's say I have an account up in Canada, it's got $1,000 in it. Even if it paid no interest, technically I need to check this box and say I've got that account there. Now, at $1,000, it's too small to have to be reported on FBAR, but if my accounts in Canada go over $10,000, or combined accounts outside of the United States go over $10,000, then I also have to move down to 7B, which says, if yes, are you required to file FinCEN Form 114? You're only required to file the form if your foreign financial account holdings exceed $10,000, and if they do, you check yes. And then it asks, if you are required to file FinCEN Form 114, enter the name of the foreign country where the financial account is located. And then finally, line 8, during 2014, did you receive a distribution from, or were you a grantor or a transferor to a foreign trust? And if the answer is yes, you may have to file 3520. Now, one of the oddball reasons why you might need to check yes to this box is if you took a distribution from, say, a foreign pension account during the year. That would be an example of a foreign trust. Interest income. So what is interest income? Well, interest income is money that you receive from money that you leave on deposit in a bank or a credit union, but it is also money that you receive when you loan money to other people. So you make a loan to someone and they pay you that back plus interest. That's what interest is. Also, money market mutual funds pay interest income. Watch out for dividends, especially credit unions. They like to refer to interest payments to their members as dividend payments, but dividends that are actually interest need to be called interest on the tax return. So although your client may not refer to the dividends they received on their credit union account as interest, you need to know that they are interest. If you receive a gift for opening an account, that gift can be considered to be interest income. There are some threshold amounts where you need to report it. If you receive a gift from a bank valued at more than $10 and you have less than $5,000 on deposit, you must include that gift as interest income. But what that means is if you receive a gift of $5 for opening an account, you don't need to report it as interest income. Now, for deposits of $5,000 or more, you only need to report interest income, the value of gifts you receive that are more than $20. In the olden days, I remember stories about banks giving people toasters when they opened bank accounts. The most recent example I can remember is where a local bank here in Portland was giving away iPods to people who opened up bank accounts, and some of them were getting 1099 INTs after they had received those iPods. Prepaid insurance premiums. Any increase in the value of prepaid insurance is considered to be interest income, and if it is applied to the payment of premiums due on those insurance policies. Interest in U.S. obligations, including U.S. T-bills, notes, and bonds. This is actually a rather important part of the 1099 INT and the reporting requirements, because U.S. bonds do get different treatment than other types of interest. The first reason why they get different treatment is because if you receive U.S. bond interest during the year and then turn around and spend it on qualifying education, you can exclude the amount that you did spend on qualifying education and subtract that off your U.S. bond interest. But the other, probably more important thing and more common thing about U.S. bond interest is that the states are not allowed to tax it. So any amount of income reported on the federal return for U.S. bond interest is going to be tax exempt at the state level. The states are not allowed to tax it. Now, at the state level, there are a couple things to just bear in mind. Some states have a tax form that you fill out and you list income items, and at no point do they ever ask for U.S. bond interest or an amount of interest income that is U.S. bond interest. And so there's nothing special you need to do for that state other than make sure you don't include the U.S. bond interest in income. But other states like Oregon and California, and probably plenty of others as well, actually start their calculations based on the federal adjusted gross income. So the very first line that we look at on an Oregon return is the adjusted gross income from the federal return, and everything starts from there. So on the Oregon return, and if you are in any other state that also works from adjusted gross income from the federal return, if your adjusted gross income on the federal return included U.S. bond interest, then you need to make sure you claim a subtraction for that on the state return because the state is not allowed to tax it. All right, types of U.S. government obligations. There are a variety of them. The first one I'm going to talk about is T-bills, and generally these have a maturity period of less than 1 year, and they are issued at a discount. The difference between the discounted price you pay and the face value of the bill at maturity is interest income to you when the bill matures. We then have Treasury notes, and these generally have a maturity period of 1 to 10 years, and interest is usually paid out every 6 months and is reported as income in the year you receive it. And then finally, we have Treasury bonds. These generally have a maturity period of more than 10 years. Interest is usually paid every 6 months and is reported as income in the year you receive it. Now, the interesting thing about these T-notes and T-bonds is that when you purchase them, you're usually purchasing them for less than their maturity price. The difference between what you pay and what you redeem them for at maturity is actually going to be interest income. And so your basis in a bond usually is the same as the selling price of the bond because any difference between the purchase price and the sales price is reportable as interest. So that's one of the things to be aware of. You'll often see brokerage statements where your client or a client is buying and selling bonds, and you should be seeing that the basis and the sales price are pretty much equal. And when they're not equal, that would be a reason to be examining a little bit more closely to try and establish why they're not equal. It is possible that there really is a change in value, that the bond has gone up or down in value, and the cost could be less or greater than the sale amount. But normally they're equal. That's just something to watch for. Now, there are different kinds of Treasury bonds. There are Series HH bonds, Series EE bonds, and Series I bonds. Series HH bonds were issued at face value, and interest was paid twice a year. You report interest income as you see it, and Series HH bonds mature over 20 years. Series EE bonds, interest on these bonds is payable when you redeem them, and Series EE bonds are issued at a discount. You can choose to report income from Series EE bonds when they mature, which is referred to as Method 1, or you can choose to report the increase in redemption value as interest each year under Method 2. Once you choose your reporting method, however, you must continue to use the same reporting method for all future bonds that you own in your lifetime. So essentially, the first time in your lifetime that you ever buy a Series EE bond, if at that time you make a decision to use the accrual method of accounting on it, you would report the interest each year as it accrues rather than all at once at the end. But if you decide to do it that way, you have to do it for all Series EE bonds that you own. And the problem is that most taxpayers aren't aware that's an option, and so they don't do it. And therefore, typically, Series EE bonds, when you redeem them, is when you include the interest in your income. Method 1 is another method used by most filers. Series II bonds. Series I bonds were first issued in 1998, and they are intended to encourage taxpayers to save more by offering inflation-adjustable rates. These bonds are comprised of two parts. The first part is a fixed rate of return that remains the same for the life of the bond, and the second is a semi-annual inflation rate that can vary every 6 months, and Series I bonds mature after 30 years. You must use the same method to report interest from all Series EE and Series I bonds you own. If you do not choose Method 2, you default to Method 1. Interest on accrued bonds, or accrued interest on bonds. when you're buying and selling bonds, it's possible that you're buying them between maturity dates. You might purchase a bond that's a 30-year bond and then sell it halfway through. And so if it's never had interest redeemed on it, it's actually going to have a higher value. It would be kind of a good deal. I buy a bond for $1,000, and when it matures in 30 years, it's going to be worth $2,000. If I sell it halfway through, theoretically, it's worth halfway between the purchase price and the sales price. So it would be a good deal for a buyer to come along and pay you exactly what you paid for it, except the bond is really worth more because it's already halfway through its maturity date. So it has this unrealized but accrued interest. So typically what happens is that when you buy or sell bonds between maturity dates, there will be an accrued interest allocation. And if you are the seller of the bond, that accrued interest will become interest income to you, and your sales price on the bond will then be equal to your cost. And if you're the buyer of the bond, when that bond finally redeems, you're going to receive a full amount of interest income that would be reported to you as interest income, but some of it would be accrued from before the time you bought it. And when that happens, if you are the seller, you are allowed to claim a deduction against that interest income called accrued interest. And to show you how that works, we go down to the Schedule B and we would enter the U.S. Treasury interest. And we actually have a client here. This illustration is based on a client who had more than one type of interest. You can see they have U.S. Treasury interest. You also have some interest off U.S. Bank. And we subtotal those interest amounts up and get $2,500. And in this situation, we're saying, hey, there's $500 of accrued interest on this U.S. Treasury interest, and so we're going to subtract that $500 out, and ultimately only $2,000 total interest is taxed rather than all $2,500 that was received during the year. Installment sale payments. If you sell property based on an installment sale, it means that you are receiving payments for your property over time. And whenever you engage in an installment sale, the IRS automatically assumes or stipulates that interest shall be included with each payment. So if you sell a piece of property in 2013 and continue to receive payments in 2014, 2015, or future years, the assumption is that part of each payment must be interest and that you can't just do an interest-free loan. And the reason for that, there's obvious reasons. The first reason is that interest is taxed at a higher rate. It's considered to be ordinary income. So there certainly could be an incentive there to say, I'm going to sell you this piece of land for $100,000, and you're going to make payments to me over the next 10 years of $10,000 a year. If your cost in the land is $50,000, you have this $50,000 profit. And you could say, yeah, this is all going to be capital gain. Over those years, if you only receive exactly $10,000 a year, IRS is going to say that in that $100,000 loan that you made, there must be interest. And if you do not stipulate what that rate of interest is, then they're going to come along and construe it for you. So anytime you sell property, you should agree on what the interest rate would be, create an amortization schedule, and for each payment made, determine what part of the payment is interest and what part is return of principal. And the return of principal, and then also the capital gain part. And the capital gain part would be taxed at capital gain rates. The interest part would be taxed as interest, which is taxed at an ordinary rate. And of course, the return of principal is not taxed at all. And we do have a whole course where we work on installment sales, including the creation of an amortization schedule. And that course is called Installment Sales. All right, seller financed mortgage. You should report any interest you receive from the buyer on your tax return. And if the buyer is making payments to you over time, as when you provide seller financing, you must generally report any part of each payment that is interest on your tax return, and you need to attach Schedule B. And on Schedule B, you need to show the name, Social Security number, and address of the person who is making those mortgage interest payments to you. I have an illustration here. Sandy Seller sold her home to Henry Homebuyer under a seller-financed installment sale. Her amortization schedule shows the interest portion of the payments that Henry made to her, and that they totaled $6,500 for the year. She also received $100 of interest income from Bank of America. Complete her Schedule B as you see here. So we have Bank of America, $100 of interest income, and then we list the buyer's name. He's Henry Homebuyer. He lives at this address on Sample Lane, and his Social Security number should be in here as well. I left that off, but Social Security number needs to be in there. And then we total up the interest amount and report it to IRS this way. Now, if you are the beneficiary of an estate, trust, S corporation or partnership, you would typically get a K-1 to show your distributive share of income from that entity. And the distributive share can include interest and dividend income. If you receive a K-1 reporting interest or dividend income, you need to give that income the same type of treatment on your tax return as if you had received the income directly. So if the K-1 shows that you received interest income, you need to report that interest income on line 8 of your tax return. If the 1099-K shows you received dividend income or capital gain income, you need to report it on the correct lines of your tax return. So you're always looking at a K-1 to identify what type of income it is reporting, and it will flow through to you taking the same character as the line number on the K-1. You would not, for example, carry all of the different characters of income from the K-1 and lump them all on line 17 of your 1040. So, of course, line 17 is the line on the 1040 where it says to report income flowing through from K-1s. Well, some income reporting through from K-1s goes on line 17, but other income needs to precisely retain its character and go to the corresponding line of the 1040. Original issue discount, 1099 OID. I don't see 1099 OIDs a whole lot, but they're not incredibly rare either. There's a few that come across my desk each tax season. OID is a form of interest, and you generally include OID in your income as it accrues, whether or not you actually receive any payments from the issuer. A debt instrument generally has original issue discount when the instrument is issued for a price that is less than its stated redemption price. So if you purchase a bond for $10 and when you redeem it, it's going to be worth $15, that's the equivalent of original issue discount. So original issue discount is the difference between the stated redemption price at maturity and the issue price. And if you purchase an instrument for less than its stated purchase price, you probably have purchased an instrument with OID on it. Now, OID typically is going to be reported on your tax return in the year you redeem it. But again, if it's one of the ones that you decide to report it as you're accruing it, then you might actually claim a discount for original issue discount at the time you receive the money. But again, most people who purchase original issue discount bonds will report the interest when they receive it. State or local government obligations. Generally, interest on obligations that are used to finance government operations is not going to be taxable on the federal return if the obligations were issued by a state or local government. So state bond interest is not taxable on the federal return. And U.S. bond interest is not taxable on the state return. So this is one of the areas that kind of gets tax preparers' minds twisted up. They get confused. You just have to remember that the U.S. government will tax its own interest, and the state government can tax its own interest. But neither the Fed nor the state can tax one another's interest. Now, it happens to be the case that most states do not tax their own interest, but will tax the interest of other states. For example, if you purchase Oregon savings bonds and you are a resident of California, California is going to tax the interest you receive on those Oregon bonds. And conversely, if you are living in Oregon and you purchase California bonds as an Oregon resident, Oregon is going to tax that California bond interest. So the best tax savings are available to individuals who purchase bonds issued by their own state. So if you are a resident of California and you purchase California bonds, the interest you receive on those bonds is not taxed by California, and it is also not taxed by the federal. You purchase California bonds and you are a resident of California. The interest on those California bonds is not taxed by California or the federal. If you purchase federal bonds, it doesn't matter where in the country you live, no state is ever allowed to tax federal bonds. Now, there's an interesting twist as well. The states are not allowed to tax bond interest on any of the U.S. territories. So if your interest comes from Guam, the Mariana Islands, Samoa, American Samoa, any of those territories, those also are not taxable by the state. So if you're a resident of any state in the country, another way to get off totally tax-free is to purchase bonds on the territories. Federal is not allowed to tax them, and neither are the states. Now, here is an illustration of how it all works. Rebecca received the following interest amounts for the year. $500 of U.S. bond interest, which is reported in Box 3 of the Form 1099 INT. $1,000 of ordinary interest reported in Box 1 of Form 1099 INT, and $800 of state bond interest that was reported in Box 8 of the Form 1099 INT. She is going to report $1,500 of taxable interest on line 8A of her federal return, and she is going to report $800 of tax-exempt interest on line 8B. When we get to the state return, of the $1,500 appearing on line 8A, $500 cannot be taxed by the state. So if you have a state return that is working off the federal adjusted gross income, you would have to enter a $500 subtraction on the state return. Now on line 8B, we're showing the amount of tax-exempt interest, and the question about whether or not this tax-exempt interest will remain tax-exempt at the state level is going to depend on what state issued the interest and what state you're reporting the income in. So again, you're a resident, say I'll just make up Idaho this time. You're a resident of Idaho. Is the $800 of state bond interest issued by Idaho? Because if it's issued by any other state, odds are Idaho's going to want a piece of that. So let's talk a little bit about Form 1099 INT. In my earlier class today on wage income, we took a long look at the W-2. I'm not going to spend quite as long on 1099 INT. I think there's less to say, but still we should explore it a little. On the Form 1099 INT, the payer of interest is required to issue you a 1099 INT if the total amount of interest they paid you was $10 or more during the year. So it's not at all uncommon with our interest rates today being so low for an individual to have $5,000 in a bank account, even an interest-bearing bank account, and receive no interest income for the year, to receive $5 of interest income for the year, a number so low that the bank just doesn't issue them a 1099 INT. So some years, just based on fluctuations in their bank account, they might come into me with a 1099 INT, and then the next year they don't have one. And so I'll say, well, last year you reported $15 of U.S. bank interest, and this year you don't have the document with you. Do you know where it is? And so they'll go off and do their research, and after wasting a bunch of time on it, come back and say, yeah, the amount of interest income that I have is so low that they didn't issue me a 1099 this year. They're only required to issue a document, 1099 INT, if the total interest reported is $10 or more. Let's move on to Box 2, which is for the early withdrawal penalty. If you purchase a CD, certificate of deposit, it usually means it's a time deposit, and you're agreeing to keep your money in that account for a certain period of time and receive a higher rate of interest in exchange for doing so. So you've locked it in for a period of time, and if you take the money out before that period of time, the bank will give you your money, and they will give you the interest that's accrued to that point, but they're going to charge you an early withdrawal penalty. The IRS wants you to know that any early withdrawal penalty appearing in Box 2 does not reduce the reportable interest income on line 8 of your tax return. So you're going to go to line 8 of the 1040 and report your interest income in full. But if you paid an early withdrawal penalty, you'll actually deduct that as an above-the-line deduction lower down on the front page of the 1040. Moving on, we have Box 3, interest on U.S. savings bonds. One of the important things to make note of, and this 1099 INT document, outside of my tax classes, you probably don't ever see 1099s that even look like these. Most financial institutions issue documents that look very different, substitute 1099 INTs they're called, and very often they'll just describe interest by the line number that it appears on. And I have in the classwork assignment here an illustration of a 1099 INT. It's a little bit fuzzy here, but let's zoom in a bit. On this 1099 INT, you can see here, it says Box 1, interest income, $1,300. Box 2, early withdrawal penalty, $0. Box 3, interest on U.S. savings bonds and treasury obligations, $250. Most of the time when you see a 1099 INT, it's going to look completely different than the 1099 INT that I have on the screen in front of you. And that is because most financial institutions are allowed to use and do use a substitute format. So when you're reading the substitute format, you really need to know in your mind what that substitute format is communicating to you. If that substitute format is saying that you have Box 3 interest, that means it's U.S. savings bond interest. And if it's U.S. savings bond interest, automatically your mind should be moving to the state return that it's not taxable there. If it's ordinary interest, it would be taxed typically at both the federal and state level. Of course, some states don't tax investment income, but most do. Box 4, federal income tax withheld. Usually you don't see federal income tax withholding off of 1099 INTs or 1099 DIVs, but it does happen. And what the financial institutions typically do at the time you open your account, they give you this Form W-9 and ask you to fill it out. And they're going to use that information to identify whether you're a U.S. taxpayer who is a resident of the United States and exempt from withholding, and to verify the accuracy of your Social Security number. And if you refuse to fill out that W-9 or don't do it correctly, or someone at the bank doesn't process it correctly, they can determine that they need to do backup withholding on you and start holding out an amount in Box 4. Where backup withholding does occur, it's usually at a rate of 28%, and you can get it refunded. You simply reflect it as federal tax withheld on the tax return, and it can be credited against all the tax you owe and excess refunded. Box 5 might reflect investment expenses that you are entitled to deduct. Investment expenses would be carried to Schedule A and could be deducted there. But the other place investment expenses come into play is if you are figuring the net investment income tax. That tax is assessed on your net investment income, and you can reduce your net investment income by investment expenses. Foreign tax, if you paid foreign tax on your interest income, it could be the case that you can just claim a credit and not complete Form 1116. So if all of the foreign tax you paid for the year was reflected on a 1099 document, and the total of that interest was less than $300 or $600 if you're filing a joint return, you can enter on the second page of your 1040 return a credit for foreign tax paid. Now, if the amount of foreign tax paid goes over $300 or over $600 on a joint return, you can still claim the credit, but you're going to need to complete Form 1116 to calculate the amount. Now, if you did pay foreign tax, this Box 7 is used to report the country that it was paid to. Box 8 shows tax-exempt interest, and tax-exempt interest is interest that is state bond interest, and tax-exempt interest is not taxable at the federal level, but any amount that goes in Box 8 does carry to line 8B of the 1040. Box 9 is specified private activity bond interest, and specified private activity bond interest is interest paid by a state government or local government that is used to finance activities that are not necessarily like a bridge or a roadway, but something different like an airport. And these particular types of interest are taxable under the alternative minimum tax. So when you see a number in Box 9, it is telling you the portion of the number in Box 8 that is specified private activity bond interest. And whatever amount appears in Box 9, you're going to have to carry that over to Form 6251, which is used to calculate the alternative minimum tax. And specified private activity bond interest is taxable under the AMT, but it is not taxable under the regular tax. All right, so let's move on past this 1099 INT, and we're going to talk now about dividends and other corporate distributions. Dividends are paid to shareholders of corporations, and they are the shareholders' share of the corporation's profits. I've long held a belief that most of the people out there buying and selling stock are really a little bit engaged in gambling. If they seem to be obsessed with the buying and selling of stock constantly, and I have lots of clients like that. You probably do too, where they buy AT&T, they sell AT&T. They buy AT&T, they sell AT&T. They're constantly buying and selling stock all the time and worried about how it's rising and falling on the stock market. And there can be reasons for doing that, of course, and there are people who specialize in managing money that way. But in general, it does boil down to gambling and what you think is going to be happening in the market. And people who do it well can successfully achieve capital gain, and sometimes they unsuccessfully achieve capital losses. But another reason to own stock in corporations is to share in the profits of the corporation. So if you purchase stock in AT&T and hold on to it long enough, and AT&T is profitable, it's going to issue a profit share, and it does so in the form of something called a dividend. And there are three types of dividends. There are ordinary and qualified dividends, there are capital gain distributions, and there are non-dividend distributions. And we're going to talk about each of those in turn now. Firstly, ordinary and qualified dividends. Ordinary dividends are the most common type of distribution from a corporation or mutual fund, and they are paid out of the earnings and profits, and they are ordinary income to you. They are taxed at ordinary rates just as interest income is. However, sometimes, very often actually is the case with dividend income, you've held that stock long enough to be awarded something called a qualified dividend. Qualified dividends are actually something that has not been around forever. I can remember when we didn't have them. Qualified dividends, I can't remember exactly when they came out. Was it under the Bush administration, or was it when Newt Gingrich did his Contract of America? One or both of those places, qualified dividends came into existence. And the benefit of qualified dividends is that they get a much lower tax rate. Depending on what tax bracket you are in for your other income, your qualified dividends will receive tax at a 0% rate, a 15% rate, or a 20% maximum rate. And so in order for a dividend to be a qualified dividend, you have to have held the stock for at least 30 days either side of the date that the dividend is issued, and in certain cases it has to be 60 days either side of the date that the dividend is paid out. If you meet those requirements, then you can get that lower capital gain rate treatment. The interesting one, though, the one I find the most interesting is taxpayers who fall into the 15 or 10% brackets and receive this qualified dividend income very often will pay no tax on their dividends at all. They'll qualify for this 0% rate, and it can be a little bit confusing when you're doing a tax return that shows that your client had $5,000 of dividend income for the year and none of it's taxable. How can that be? And it is because of the capital gain rules that are being applied. If you move into the 25% or higher bracket, the maximum capital gain rate or qualified dividend rate that applies to you is 15%. And if you are a filer that has achieved that maximum tax bracket of 39.6%, then the maximum qualified dividend rate that applies to you is 20%. Now, the qualified dividend, there is a definition of qualified dividend, and typically it refers to U.S.-based corporations, but can also apply to qualified foreign corporations. And most foreign stock that is publicly traded is probably going to be qualified interest. Capital gain distributions, that's the next item we're going to look at. Capital gain distributions are paid to you or credited to your account by mutual funds and also by real estate investment trusts. And capital gain distributions are your share of the profits from the buying and selling of stock within a mutual fund. So rather than purchasing and selling stock directly yourself, you may decide to just select a mutual fund and purchase shares in that mutual fund. And then meanwhile, in the background, the people who manage that mutual fund, it's their job to buy and sell stock inside that mutual fund. And when they buy and sell stock, they're going to be achieving capital gains and capital losses. And if they have net gains for the year, those net gains are going to come through to you as capital gain distributions. Regardless of whether the stock sales within the mutual fund were short-term or long-term, any amount reported as a capital gain distribution on a 1099 DIV is always going to receive long-term treatment and therefore will be eligible for the same reduced 0%, 15%, and 20% capital gain rates. Non-dividend distributions, these are distributions that are essentially a return of cost to you. If you purchase stock for $10 a share and then you receive a non-dividend distribution of $2 a share, that's a return to you of your cost, and it simply reduces your basis in the stock that you own. You don't trigger a gain from non-dividend distributions until the amount of those non-dividend distributions exceeds your cost. Typically, when you see a number in box 3 on the Form 1099 DIV, your software will have no line or place to put it, and it's because it's not taxable. Dividends used to buy more stock. It could be, and often is the case, that rather than receiving your dividends as a check in the mail, although some people do that, you have a system set up where your dividends are being reinvested to purchase more shares in the corporation or the mutual fund in which you are invested. And you should watch out for the fact when you're doing that, because if you're reinvesting your dividends, they're still fully taxable as if you had kept the money, plus any amount you reinvest to purchase new stock or additional stock is going to have a specific cost associated with the stock. So if you receive $10 of dividends and you use those $10 of dividends to turn around and buy more shares, your cost in those shares would be the $10 that was reinvested. Most of the time, brokerage accounts are going to be tracking that. There's going to be devices in place or systems in place to tell you what your reinvested dividends are. But I have in the past had to figure this. I had a client that every year he was bringing me return for a trust, and I was preparing the tax return for this trust. And every year the trust was showing all of these dividends that were getting reinvested, but it was also showing sales of the stock. And this was back in the days before any kind of tracking was being done or was required to be done. And so finally I sat down after having figured out what all these net reinvestments of dividends had been and how many shares had been purchased with that to calculate the average cost per share, gave that to the brokerage house, and the brokerage house has been tracking it ever since. You do have to watch out for those dividends and make sure that any reinvestments are included in income, but also that the cost is properly tracked. There's some more information in here about distributions of stocks and stock rights. And typically, if you are given a right to purchase stock at its fair market value, that's not going to be income to you. But if you are given a right to purchase stock it's less than its fair market value, there can be income to you. And if you are an employee of a corporation and you purchase stock at less than its fair market value, and then you turn around and sell that stock, at the point you sell that stock, you're typically going to have income that you need to report. We really get into stock purchase plans and employee stock purchase plans in another course I'll be teaching later on in May, which is we teach basis of assets in the morning class, and then in the afternoon class we're going to focus the full class in the afternoon on employee stock purchase plans and stock options. So let's take a look now at the 1099 DIV. Box 1 of Form 1099 DIV, Box 1A, shows total ordinary dividends received for the year. And Box 1B says what portion of Box 1 is qualified for the lower tax rate. So you don't take Box 1 and add Box 1B. Box 1B is the portion of Box 1A that should be carried to the capital gain worksheet and used to figure a reduced rate of tax. Box 2A is the capital gain distributions you received for the year, and these would carry to Schedule D. But if Schedule D is not otherwise required, you can enter the amount in Box 2A directly on line 13 of the tax return. Box 2B reports unrecaptured Section 1250 gain. Section 1250 gain is the gain on recovered depreciation on the sale of real property. So, for example, you sell a real estate holding. That's an example of 1250 property. And any depreciation that's been claimed on that property is reported as income to you when you sell, and it's taxed at a maximum rate of 25% rather than the lower maximum rates of, say, 0, 15, or 20%. So an amount in Box 2B would carry to the capital gain worksheet and would also carry to the Section 1250 gain worksheet and appear on line 19 of the Schedule D. Moving on to line 2C, it says Section 1202 gain. Section 1202 gain represents investments in small corporations, basically at the startup point. There's all kinds of rules about what kind of corporation can qualify to be a Section 1202 gain. But if there's a legal document establishing that the gain is Section 1202 gain, the 1099 DIV will show the amount of Section 1202 gain, and it could be that a good portion of that gain is not taxable at all. And then we have the sale of collectibles, 28% gain. If you sell, I don't know, a collection of paintings, or I don't know, it must be a mutual fund that's invested in these collectibles, whatever they are, and they're issuing you a 1099 DIV showing that these collectibles were sold, those collectibles are taxed at a maximum rate of 28%. I have no idea why collectibles are taxed at a higher rate. And then line 3, non-dividend distributions, that's the amount that's not taxable. Any amount in Box 3 typically would not be includable in income anywhere on your return. Box 4, again, if you haven't provided the correct information or adequate information to the payor is required to do backup withholding. Sometimes backup withholding is also ordered by the IRS. If you're delinquent on your taxes and you haven't been making payments, you haven't got an installment plan in place that you're keeping up on, the IRS can go to the investment brokerage firm that you have your money with and order them to do backup withholding. They could also just put a lien on the account and empty the whole thing, but backup withholding is something that they may order. Next up, we have investment expenses. Again, investment expenses can be deductible on Schedule A and also are deductible against the net investment income tax. Line 6, foreign tax paid. As with the 1099 INT, any amount shown on a 1099 DIV can be entered directly on the 1040 form as a foreign tax credit to offset your federal tax. as long as the amount is $300 or less or $600 or less on a joint return. If the amount goes over, you need to attach Form 1116. And if you are attaching Form 1116, the form wants to know what country you paid the tax to. And then we have something called exempt interest dividends. Exempt interest dividends are essentially interest. They don't get reported as dividend income at all. They get reported as interest income. So this one is kind of confusing. And then we have specified private activity bond interest dividends. Again, these are exempt interest amounts that would carry to Form 6251 and be used in calculations of the alternative minimum tax. Let's move on to insurance dividends. Dividends you receive from your insurance policy that are return of premiums or are used to pay premiums are not taxable until they exceed the total of all net premiums you have paid. However, if you receive interest payment on these dividends, then the interest is taxable as interest income. Nominee interest and dividends. If your Form 1099 DIV or Form 1099 INT includes amounts belonging to another person, you are considered to be a nominee recipient, and you report the full amount of interest or dividends on Schedule B and total all interest and dividends you are reporting on the Schedule B, and then on the Schedule B you say nominee distribution and you subtract it out again. Works a little bit like that accrued interest example I showed you earlier, but rather than explain it with words, I think it's better to show you. And so I've created an illustration here where we have a nominee recipient. In this story, we have Galadriel and her sister Arwen. They are joint owners of a savings and investment account at Rivendell Community Bank and also at Two Towers, Inc. Their Forms 1099 INT and DIV were issued to Galadriel by these financial institutions, even though the money and interest income on these accounts belonged to Arwen. Galadriel also received a 1099 INT from Rohan Bank. Well, why would there be interest paid to one person when it isn't their income? And there can be reasons why this is done. You might have a parent who sets up an account for their child, and the parent is the first name on the account, but all the money in it belongs to the child. That would be an example where you've got a controlling interest on a bank account really for the benefit of someone else. It could also be, in the case of Arwen and Galadriel, that Arwen wants Galadriel to have access to this money. Maybe Arwen is sick, or Arwen is concerned when she's traveling out of the country that she wants Galadriel to have access to her funds. So there could be a variety of reasons why someone else's name is first on an account. But ultimately, when an account is opened and that account has two signing authorities on it, however you fill out the paperwork at the bank and whose name and social security number appears on it first, or whichever box you check there, the bank is pretty much going to issue the 1099 INT in one social security number. And if that social security number is not the total 100% owner of the income, and some of that income needs to flow through to the other owner on that bank account, that's when you're going to have a nominee distribution that needs to go on. So here we have the Rohan Bank interest statement showing $800 of interest income. And the $800 of interest income from Rohan Bank is also going to have to be reported on Galadriel's Schedule B, because you can see it's her name and social security number on the document. However, since the Rohan Bank interest actually belongs to Galadriel, she's going to keep it on her return, and she will not include it in the nominee amount. Then we move on to the next 1099 INT, which is from Rivendell Bank. And the $1,200 of interest income you see reported here is under Galadriel's social security number, but it actually belongs to Arwen. So she's going to need to nominee that $1,200 out. And then finally, there is a 1099 DIV issued by Two Towers, Inc., and all $500 shown on here actually belongs to Arwen, but it's being issued to Galadriel. So Galadriel has to report all of the income off of all three of these documents on her own Schedule B. So Galadriel's Schedule B is going to show $800 of interest from Rohan. It's going to show $1,200 of interest from Rivendell, and it's going to show $500 of dividends from Two Towers. We go over to her Schedule B, and on the Schedule B, we show the interest payments received. We subtotal that interest up, $2,000, and then we subtract out the nominee distribution amount. And the total is the amount that Galadriel will actually report as income on her tax return. We then go down and show the Two Towers, Inc. dividend income coming in. We show the nominee amount going out. And ultimately, because all of the dividend income belongs to Arwen, Galadriel will report 0 dividends on her own return. And then, of course, she is reporting that she does not have interest in a foreign financial account and did not receive distributions from a foreign trust. Now, we're not done, though. Even though Galadriel has nominated the interest and dividend income off to Arwen, she still has to do more work, and that work is to issue Arwen a 1099 INT and a 1099 DIV. So we're going to show on the 1099 INT Galadriel as the payer, Arwen as the recipient, and the amount of interest that she nominated off to Galadriel. And similarly, under the 1099 DIV, we're going to show Galadriel as the payer, Arwen as the recipient, and the amount of dividend income that she is nominating over to Arwen. Password number 1 is Canberra, CANBERRA. Reporting requirements for foreign account holders. This has been an area of concern, discussion, hyperventilation for me and my clients for a number of years now, and no doubt it has been for many other tax practitioners out there as well. And here's the bottom line on it. If you have interest in or control over a foreign financial account or trust, you may be subjected to additional reporting requirements, and these include the fact that you must file Form 114 with FinCEN if the aggregate value of all foreign financial accounts you hold an interest in exceeded $10,000 at any time during the calendar year reported. In addition, U.S. taxpayers with specified foreign financial assets that exceed certain thresholds must report these assets to the IRS with their tax returns, and they do so by attaching Form 8938 to the tax return. Title 31 for FBAR requires U.S. persons to report interests in non-U.S. bank accounts and financial accounts to the Foreign or the Financial Crimes Enforcement Network on FinCEN Form 114, Report of Foreign Bank and Financial Accounts, which is where we get FBAR from, FBAR for report. So the term FBAR is referring to this report of foreign bank and financial accounts. And so you'll hear FinCEN and FBAR kind of used interchangeably, and when they are, they're referring to this Form 114 that needs to be filed. Foreign financial accounts that are reportable on FBAR or on Form 114 include bank accounts such as savings accounts, checking accounts, and time deposits. They also include securities accounts such as mutual funds, brokerage accounts, and securities derivatives or other financial instruments accounts. They also include accounts where assets are commingled, such as in a mutual fund. And finally, any other accounts maintained in a foreign financial institution or with a person doing business as a foreign financial institution. Typically, the types of things that fall into this category that you might not readily think of are foreign pensions. If you have a foreign retirement account or a foreign pension account, that account typically also needs to be reported to FBAR. And then foreign financial accounts, though, do not include the following types of accounts: individual bonds, notes, or stock certificates that are held by a filer, and unsecured loans to a foreign trade or business that is not a financial institution. So let's look a little bit more closely at Form 114. You need to file the report if your non-U.S. financial account holdings during the year totaled more than $10,000 at any time during the year. This is not saying that you must have a bank account that is over $10,000 to be required to file FBAR. The reality is you look at all of the foreign financial accounts you hold or have an interest in, and if the total of those goes over $10,000 at any time during the year, even if it's for just a day. For example, I had a client who sold a piece of land in India, deposited the money into an Indian bank account, and then almost immediately wired it over to the United States. So the money that was in that foreign account was just there for a couple of days. That meant that at some point during the year, the foreign financial account went over $10,000 and had to be reported. But similarly, you could have a situation where an individual has one account with $1,000 in it and another account with $8,000 in it and a third account with $3,000 in it. None of them are more than 10, but when you add them together, you go over 10. And so FinCEN Form 114 would need to be filed. FinCEN Form 114 needs to be filed by U.S. persons who meet the filing requirements. United States person means a United States citizen, a United States resident entity, including but not limited to corporations, partnerships, or limited liability companies that are created or organized in the United States or under the laws of the United States, as well as trusts or estates formed under the laws of the United States. So one of the things to bear in mind is that when you're filing an individual return, you report ownership of a foreign financial account by checking the box on Schedule B in Part 3. But if you are a trust or you are a corporation or an S corporation or a partnership, the checkbox to indicate foreign ownership of a financial account is actually located in other places on those forms. And all of those different entity types have a place on their tax forms where you check whether or not they have ownership in a foreign financial account. And if they do, then that entity may be required to file the FBAR report. Now, there are some exceptions to the FBAR reporting requirements. You're not required to file FBAR if you are a U.S. person, and the foreign financial account includes certain foreign financial accounts jointly owned by both spouses. If one spouse is reporting on FBAR their joint ownership with you and you have no other financial accounts, then you don't need to file your own FBAR. You can just go on that joint FBAR. Anytime you have your own separate financial account outside of the country, you still need to file your own FBAR. If you are an United States person included in a consolidated FBAR, also you don't need to file it. Consolidated nostro accounts or correspondent nostro accounts, foreign financial accounts that are owned by a government entity, foreign financial accounts owned by an international financial institution, IRA owners and beneficiaries, but I don't want you to confuse an IRA owner and beneficiary with something that it's not. This is not referring to you owning a foreign IRA. If you own a foreign IRA, that is a foreign financial account and you do need to report it on FBAR. But if your IRA invests in foreign financial accounts, the IRA does not need to file FBAR. That's what it's saying. Participants in and beneficiaries of tax-qualified retirement plans. Certain individuals with signing authority over but no financial interest in a foreign financial account, trust beneficiaries, and foreign financial accounts maintained in a United States military banking facility. FBAR instructions provide additional information to determine eligibility for an exception and exception requirements. Go to the FBAR page and read the instructions to learn more. Now, if you are filing FBAR reports for your clients, and our firm does a lot of it, we're doing them all the time. You do need to register yourself so that you can offer this service to your clients because it's not done with the tax return. You do need to go to the FinCEN site, and I've got a link to it here. You click on that link and you go to the FinCEN site. And when you do that, it lands you on a page, and you would click that you are an institution, because down here where it says file an individual FBAR, that would be if you're filing your own personal FBAR. But if you're filing an FBAR for anyone else, you would register as an institution. And then it takes you to links becoming a BSA e-filer. You have to go through an online application process. And once that's done, you are given the information needed to file as a third party. Now, once you are able to file as a third party, you're going to have your clients sign something for you, because if they're not filing their own FBAR and they're asking you to do it for them, you're going to need their permission to do so. And so FinCEN created this particular form 114A, and this works similarly to an 8879. So when you're filing an individual return electronically, you complete form 8879 and have your client sign that, and it authorizes you to file the return for them electronically. This is the equivalent form for filing FBAR electronically. So you will enter the owner's name, the owner's social security number. You will get the owner of the financial accounts to sign the form, and then that gives you permission to e-file their FBAR for them. Do not send the 114A form to FinCEN. FinCEN does not want to see it. They also don't want to see paper copies of FBAR. They must be filed electronically. They don't want to be processing any paperwork. With respect to FBAR, there is no extension of time to file. The deadline for filing FBAR is different than the deadline for individual returns. The individual return deadline is, of course, April 15th for most filers, but the FBAR deadline is June 30th. So typically, during the tax season, when our clients are coming in, we're preparing their individual returns and we're preparing FBAR, and we're doing them both at the same time. But the FBAR deadline is really June 30th, and there is no extension beyond that. If you file after June 30th, you're automatically late. And there can be penalties for failing to file FBAR. And we're going to talk a little bit about these here. Firstly, we have a negligence violation, which is up to $500 for each violation, a non-willful violation of $10,000, a pattern of negligent activity, which can be a $50,000 fine, willful failure to file FBAR. In other words, you knew you were supposed to file it and deliberately didn't. Then the civil penalty can be $100,000 or 50% of the amount that you have in your account. Well, just imagine if you have $1 million in your foreign financial account and you willfully fail to file FBAR, then they can take half of it, $500,000. And that's just the civil penalties. Then we can move on to the criminal penalties where they could grab another $250,000 from you and send you to jail for 5 years. Willful failure to file FBAR or retain records of the account while violating certain other laws, that's also a penalty of the greater of $100,000 or 50% of the amount in the account. And the criminal penalties move to $500,000 or 10 years in prison or both. And then finally, knowingly and willfully filing a false FBAR up to the greater of $100,000 or 50% of the account balance, plus $10,000, 5 years in prison or both. So now we're going to talk about something called the Offshore Voluntary Disclosure Program, because you can see up here, I showed you that failure to report your foreign financial accounts can get you in big trouble. And what happens if you're one of these people who knows that you should have been reporting to FBAR all these years, knows you've been not reporting foreign income and you've been doing it on purpose? Is there any way out of this trap? And the answer is yes, there is. There is the Offshore Voluntary Disclosure Program. And taxpayers who hold offshore accounts and have income from these accounts that was not reported to the IRS should go out of their way to voluntarily disclose the fact that they have not been reporting these accounts to become compliant. And voluntary disclosure enables the taxpayer to become compliant, avoid substantial civil penalties, and generally eliminate the risk of criminal prosecution. Also, it allows them to calculate with a reasonable degree of certainty the total cost of resolving all offshore issues. I don't know if any of you caught it, but right in the middle of tax season, 60 Minutes actually ran a story on a man who had stolen a huge volume of information off of the computers of one of the big banks in Switzerland. He absconded with the information. I don't know how much he was motivated by a desire to do right as he was by a financial motivation to maybe sell the information. But whatever the case was, he stole this information from the bank and ended up speaking to reporters about it. And one reporter brought in other reporters, and eventually there was a whole team of reporters representing different nations, filtering through all of this stolen bank information, identifying all these people who had secret accounts in this Swiss bank. And then the foreign countries got involved because really what they were looking at was information very often relating to illegal crime, not just individuals in the United States and other countries who had foreign financial accounts and were not disclosing income on their national tax returns, but also because there was criminal activity. Owners of these accounts were nefarious, you could say. And it was just an interesting story to have it come out during tax season because it really ties in with what's going on with FBAR, because the entire purpose of FBAR, well, it's really twofold. One part of FBAR is to ensure that taxpayers are reporting and disclosing all of their income worldwide when they file their tax return and paying tax that they owe on it. And the other side is to keep track of criminal activities and money laundering. And what was interesting about what came out of Switzerland is that it was a wealth of information that the IRS and other nations could also use to track down people who have illegal income or were illegally not reporting the income that they had legally obtained. There's a lot of people out there who have become alarmed by the fact that the IRS is now able to track them down. And it's more than just that one incident with that stolen information. We're also dealing with FATCA, and FATCA is an international tax agreement basically bullied on foreign nations by the United States government to force those nations to force their financial institutions to report income items and financial account information to the IRS. The bottom line is the days of secret Swiss bank accounts and secret Cayman Island accounts are coming to an end. And these people who may have gotten away for decades hiding their money illicitly in these foreign nations, their number's up. And it's just a matter of time before they get caught. So what are their options? Well, some of them are essentially running and hiding, and others who don't want to do that, who want to stay here in the United States and catch up on things, are being given an option, and that is the voluntary disclosure program. It's called the Offshore Voluntary Disclosure Program, and it is specifically designed and intended for taxpayers who have exposure to potential criminal liability and or substantial civil penalties due to a willful failure to report foreign financial accounts and to pay all the tax due in respect of those assets. The deadline to apply for the voluntary program, currently there is no deadline. There's been a series of voluntary disclosure programs, and currently we have one in place that has no set deadline. But to talk about it a little, I did a little bit of research preparing for today's class. Sometimes I just like to understand the history of things, and so I did a little bit of a historical search for you on this topic. Why we never heard about it until a few years ago, and why all of a sudden now it's the big thing that everyone is worried about. So offshore reporting requirements are really not new at all. They stem from the Bank Secrecy Act of 1970, which was also known as the Currency and Foreign Transaction Reporting Act. Historically, enforcement efforts relating to disclosure of foreign financial accounts were virtually non-existent, and taxpayer compliance rates were really low. They estimated only 20% of taxpayers were complying with them. But following the September 11, 2001 terrorist attacks, the federal government gave increased attention to enforcing anti-money laundering laws. So money laundering had gone on for years. FBAR was supposed to be helping to find it, but enforcement was almost non-existent, so it was really not accomplishing what it needed to. Then in April of 2003, the IRS was delegated the civil enforcement authority for FBAR and introduced the first offshore voluntary compliance program. In 2009 and again in 2011, IRS offered temporary initiative programs to encourage non-compliant filers to come forward. And the first one that really got the most media attention in my mind, or the most wake-up call for the most people, was the 2009 offshore initiative. And that was the very first year I'd ever heard of it. There was a day where the light came on for April, and it was 2009. And what happened was I had a client who wandered into my office. He actually wasn't a client. He was fishing for information and wondering what to do, and he came in and started asking me questions about something I really knew nothing about, just hadn't paid attention. It hadn't mattered to me to that point in my life. But I quickly researched what his story was about and realized, oh, this is pretty interesting. And it turns out he had $2 or $3 million somewhere else, had not been reporting income on it deliberately, knew he hadn't been reporting income on it. So I looked at the terms of the voluntary compliance, and I said, well, if you want to come forward under this particular program, it's going to cost you 25% of what you hold, or 23%, whatever the offer was at that time, and it's going to be expensive. And he said, I really don't know what to do. I don't know if I want to do that. He was a citizen of another country. I don't know if it was Brazil or what it was. And I said, well, you could always just go home and say goodbye to the United States, and they'll probably never know, and that'll be the end of you. And he pretty much disappeared and never saw him again. He probably went back to his home country, and that was the end of it. But then I started to get phone calls from out of the blue from people living in Canada. These were Canadians, and what was happening is there was some kind of media campaign that went on in Canada that they were picking up on, or their chartered accountants in Canada were picking up on, and they were saying, you know, you've got these compliance issues as a Canadian, and somehow they were finding me. I don't know how. Google searches or something. I am Canadian myself, and it's on my biography. Maybe that was all it took. But they were finding me and calling me, and a number of them were pretty panicky. But all in all, most of them were people that were very innocent. They hadn't done anything wrong perceivably. I mean, they were Canadian residents. Some of them were Canadian citizens. It just happened to be the case that they were either also green card holders or they were also U.S. residents. But their ties were to Canada. Their life was in Canada. They'd grown up in Canada. They'd been there for many, many years. And were just now realizing that they had some kind of filing requirement in the United States. And it all in all didn't seem fair. I mean, they were reporting and paying tax on all their income to Canada. Why would the United States come along and have any hand in that? So it was very stressful for them, and this offshore voluntary disclosure program made no provision for them. Here they are, quite innocent, doing nothing voluntarily, nothing willfully. What could they do? And my answer to them was, I'd just lay low. I don't think this program is for you, and I wouldn't recommend it. So that's what they did. They just laid low. But one of the things they could do was to file back FBAR reports and begin filing U.S. tax returns as they were required to. And some of them have started to do that. So let's move on a little bit with this problem. We have an offshore voluntary disclosure program that says if you have overseas assets that you didn't disclose on American tax returns and didn't disclose through FBAR, the federal government wants a sizable portion of it. So let's go back to our Canadian people there. They've lived in Canada their whole lives. They've been working there for 40 years. They've got their life savings in Canada, and all of a sudden Uncle Sam here in the United States wants half of it or a quarter of it to leave him alone for the future. Does that seem right or fair? The answer is obviously no. And any opinion I have on the matter has been shared by the Taxpayer Advocate Office, and I actually took a look at her annual report to Congress for 2013, and she talked about it quite a bit there. In the annual report to Congress, the Taxpayer Advocate described the offshore voluntary disclosure program as a good deal for bad actors, but not for benign actors. In other words, the OVD program was designed to target willful violators, but made little or no provision for non-willful violators who failed to comply with foreign financial reporting requirements because they were unaware of the law. And as a result, many of the people who decided to participate in the voluntary offshore procedures were people who shouldn't have been using them at all. And what they were finding is that a great percentage of the filers under these offshore programs were non-willful violators that were paying penalties directed at willful violators, and the IRS had no mechanism in place to deal with that and was essentially taking the money and running and giving these taxpayers no way out. Now, the no way out problem for people who voluntarily opted into the system and maybe shouldn't have, there's still nothing to be done about that. IRS has its money and it's keeping it. But for people who did not participate in the offshore compliance program and were non-willful violators, the idea is don't get them to participate in that program. Now, what do? Well, until 2014, I didn't know what to tell people other than, to bring up to date their tax returns and their FBARs and hope no one noticed. And that's a pretty common recommendation I found reading articles on the internet and so forth. But in 2012, the IRS did come out with a streamlined compliance procedure for non-residents. Didn't do anything for residents in the United States, but it did offer some relief for non-residents who could essentially catch up on all of their tax returns, catch up on FBAR, and if they didn't owe more than a certain amount of tax, they basically got out of jail for free. But that still didn't solve the issue for the majority of the filers I was dealing with who were residents of the United States. And again, the Taxpayer Advocate threw criticism at that. And in 2014, apparently the IRS listened to her. So on June 18, 2014, the IRS adopted some of National Taxpayer Advocate recommendations, and it modified the terms of the 2012 program called the 2012 OVDP and created a new 2014 streamlined program. And anything you see here that's clickable, that's where you can go and read more, okay? And that program, the 2014 program, is the first one where I felt as a tax preparer and also as a tax educator that I had something I could put my hands on and go, yes, this is something my clients can use. And wouldn't you know it, I'm already doing one. I've got a client who is ready to sign off on the first streamlined compliance procedure, and he is eager to do it. I can't talk him out of it. I've tried to. Are you sure you want to do this? Because he's planning on moving back to Japan in a couple of years, and odds are he'd never get caught and just leave the country, and that would be the end of it. But he is a very, very honest man who wants to come right, and he is of the opinion that all of the past years he should have been paying tax and wasn't, and he wants to do the right thing and come into compliance. So I'm actually, you can say I've got my first one that we're going to be submitting actually mid-May. Now, let's talk a little bit about the 2014 streamlined procedures, because there's actually two halves to the 2014 procedures. There are domestic streamlined procedures, and there are streamlined foreign offshore procedures. And if you want to learn more about the streamlined foreign offshore procedures, follow the link here, and for domestic procedures, follow the link on the upper level here. The purpose of the streamlined procedures, whether you are domestic or foreign, is to bring into compliance taxpayers who have been out of compliance and are able to certify that their failure to report the foreign financial accounts and pay all asked tax due on those did not result from willful conduct and was rather due to ignorance. Now, a taxpayer to participate in the program, they are designed for taxpayers with a streamlined procedure that allows them to file amended or delinquent returns and then offers terms for resolving their tax and penalty issues and filing those amended returns and paying any tax due with them, and also terms for resolving their tax and penalty obligations. So essentially, the streamlined procedures allow them to file their back FBAR reports, to amend the last 3 years of federal returns and pay any tax due with them as a result of adding in that foreign income, and then to pay a nominal, relatively nominal fee and get off the hook forever. So let's talk about how these work. I'm specifically going to look at the streamlined procedures for domestic U.S. residents. And they are pretty specific. The instructions are quite detailed, and in my mind, after spending several hours reviewing them and thinking about them and researching them, they make sense and they're straightforward. So that's what I'm going to show you, is what I've managed to put together with my research over the last few weeks. So the 2014 streamlined procedures provide the following benefits to non-willful violators who are residents of the United States. A taxpayer who is eligible to use these streamlined offshore domestic procedures and who complies with all of the instructions below will be subject only to the Title 26 miscellaneous offshore penalty and will not be subjected to accuracy-related penalties, information return penalties, or the FBAR penalties. Even if returns properly filed under these procedures are subsequently selected for audit under existing audit procedures, the taxpayer will not be subjected to accuracy-related penalties with respect to amounts that are reported on these returns or to information return penalties or FBAR penalties unless the examination results in a determination that the original return was fraudulent or that the FBAR was willfully not filed in the first place. So in other words, you can't take advantage of this particular program and get off the hook if all along you were a willful violator. But if you were a non-willful violator, this is the program for you. Now, one of the bad things, and something that the taxpayer advocate is still angry about, is that anyone who out of good intentions decided to opt into the offshore voluntary compliance procedures that seek out a far higher percentage as a settlement. And if you are a willful violator who is participating in the offshore voluntary disclosure program, the penalty there is, I believe, 27% of your offshore holdings. Not the 50% plus the $500,000 fines, but 27%. So it's a good deal for those willful violators. But for those non-willful violators, 27% is exorbitant and far exceeds any other penalties they might receive under the law. And this is where the taxpayer advocate says that's really unfair. And the other thing she's saying is if you are a person who was a non-willful violator who has opted into this program for willful violators, you're stuck. You're not going to get off the tax you paid under that program. And she thinks that's not fair, and I tend to agree, so we'll see. Maybe something will happen, probably not. Streamlined domestic offshore eligibility. Let's talk about that next. Individual U.S. taxpayers or estates of individual U.S. taxpayers who are seeking to use the streamlined domestic offshore procedures must meet these requirements. Streamlined non-resident disclosure program is a better deal. If you are outside of the United States, residing outside of the United States, the non-resident disclosure program allows you to get off with a 0% penalty. You file all the paperwork and the penalty is 0%. But if you are a resident of the United States, the penalty will be 5% of your offshore holdings. So the first rule for people who are filing under the domestic procedures is that they should not be eligible for the non-resident procedures because the non-resident procedures are better. Also, number two, you must have previously filed a U.S. tax return for each of the most recent 3 years for which the U.S. tax return due date or properly applied extended due date has passed, and have failed to report gross income from a foreign financial asset and pay tax as required by U.S. law. And you may also have failed to file an FBAR Form 114 or the Form 8938, which is used to report foreign financial assets as well. So you need to have failed on a number of fronts. You need to have failed to report the income. You need to have failed to disclose the assets. And also, those failures need to be from non-willful conduct. In other words, you just didn't know. It isn't about whether you should have known. It's basically about whether you didn't know. So it was a good faith misunderstanding. For returns filed under these procedures, retroactive relief will be provided for failure to timely elect income deferral on certain retirement and savings plans where deferral is allowed by the applicable treaty. The proper deferral elections with respect to such plans must be made with the submission. So if your client has offshore financial accounts that include pension plans, you're going to have to actually go to the tax treaty with that foreign nation and see if the tax treaty allows for deferral on those plans. And if it does, you need to file a request or a difference in tax methods, what do they call it, tax treaty provision with the return and make an election to defer that income. The only country that it is simple to do that with is Canada. There are actually specific procedures in place for doing that with Canada, but for all other nations, it's as complex as it could possibly be, and I'm just going to leave it at that. Foreign financial assets subject to the penalty. A foreign financial asset is an asset that is reportable to FinCEN Form 114 or on Form 8938. Examples of foreign financial assets can include financial accounts held at foreign financial institutions, financial accounts held at a foreign branch of a U.S. financial institution, foreign stock or securities not held in a financial account, foreign mutual funds, and foreign hedge funds and private equity funds. Foreign financial accounts, however, do not include foreign real estate holdings. So foreign financial assets, though, because they're different than accounts, can include foreign stock. So if you're an owner in a foreign corporation, for purposes of the disclosure of foreign financial assets, individual stock holdings do apply, but for FBAR they don't. There are some differences, and I'll get into that in a bit. Calculating the penalty. A foreign financial asset is subject to the 5% miscellaneous offshore penalty in a given year in the covered FBAR period if the asset should have been but was not reported on an FBAR FinCEN Form 114 or on Form 8938 for the year, or was reported on Form 114 and 8938 as required, but the gross income from that account was left off the tax return. The Title 26 miscellaneous offshore penalty, again, is 5%. But it is based on the highest aggregate balance of a taxpayer's foreign financial assets that are subject to the miscellaneous offshore penalty during the years covered. So what that means is if you're looking at a 6-year period where you didn't file FBAR and should have, or a 10-year period where you didn't file FBAR and should have, IRS says take the most recent 6 years, find the year that had the highest value, and base your penalty on that year. Highest aggregate balance is determined as follows. Add up the year-end account balances and year-end asset values of all the foreign financial assets that are subject to the miscellaneous offshore penalty for each year in the covered tax return period and the covered FBAR period. Then select the highest aggregate balance value from among those years. The covered tax return period includes tax returns for the most recent 3 years for which the deadline or properly extended deadline has passed. And the covered FBAR period includes the 6 most recent years for which the FBAR deadline has passed. Interestingly, as I teach this class, it's April 30th, 2015, and the filing deadline for the 2014 tax year, IRS Federal 1040 returns, has passed. It's possible you're on extension, but if you're not on an extension, it's now passed. However, the FBAR deadline has not passed. It's still ahead of us on June 30th. So it's possible to be straddling these time frames. So the deadline for most tax returns is April 15th, and the FBAR deadline is June 30th. So it's possible there for the FBAR period to include up to 7 years, where the tax return period will include only 3 years. And I've done an example here for you of how to prepare the offshore streamlined forms. And I have an application that is being submitted under the 2014 streamlined procedures on May 31st of 2015. Keiko Ono moved to the United States from Japan in 2000. She prepared her own tax returns each year, and she resided in the United States, but she did not report income from her Japanese property and investments because she thought they were not subject to U.S. taxation. She has to file Japanese returns on them, and it just assumed it's in Japan. What's in Japan stays in Japan. It has nothing to do with the United States. Then in February of 2014, Keiko decided to visit a free Vitus site to ask about how to report her Japanese Social Security income, which she began receiving in 2013. The Vita volunteer she spoke to notified her that the Japanese investments she had were reportable and that she should seek professional help because she was subject to severe penalties under FBAR and FATCA. So Keiko went home very worried and decided to make an appointment with a tax professional. And in March of 2014, Keiko visited that tax preparer who prepared her 2014 federal return as well as the FBAR return for 2014. And these were properly prepared and reported all of her worldwide income. FBAR was submitted showing all of her foreign financial assets and the account balances that they have. And she also attached the Form 8938 showing her foreign financial holdings because they were over $50,000 for the year. Then on May 31st, 2015, Keiko Ono submitted Form 14654, certification by a U.S. person residing in the United States. Now, because she filed between April 15 and June 30th, Keiko's most recent 3 years of returns will include 2014, 2013, and 2012, while her most recent 6 years of FBAR that have not been filed and on which the penalty could be calculated include 13, 12, 11, 10, 9, and 8. If Keiko filed Form 14654 on September 15, 2015, then the most recent FBAR years would be 14, 13, 12, 11, 10, and 9. And if she filed Form 14654 on March 15, 2015, then her most recent tax years for which the filing deadline has passed would be 13, 12, and 11. So you're basically looking, what date am I on today, and looking at what filing deadline has most recently passed and going 3 years from that. Now, the benefits of using the streamlined domestic offshore procedures, a taxpayer who is eligible to use these procedures will be subject only to the Title 26 miscellaneous penalty. Even if the returns are filed under this procedure are selected for audit at a later time, accuracy-related penalties will not be applied. And they also receive retroactive relief for failure to timely elect income deferral on certain retirement accounts and savings plans. So previously assessed penalties, though, will not be abated, as I said. Let's move on to specific instructions for streamlined domestic offshore procedures. This is where we're going to talk about the specific things that have to be done as a part of the application program. Number one, for each of the most recent 3 years for which a U.S. tax return due date has passed, submit a complete and accurate amended return using Form 1040X. Be sure to attach to that amended return all other required returns and forms. For example, if you need to file an 8938, be sure it is attached. Even if these information returns would normally not be submitted with the Form 1040. For example, 3520, that's not normally submitted with the 1040, but if you are submitting your application, they want that with it if you are required to complete it. You may not file delinquent income tax returns using these procedures. You need to be filing amended returns. Include at the top of the first page of each amended return in red writing, streamlined domestic offshore. So it's written in bold on the top of the 1040X for each year you are filing in red ink, streamlined domestic offshore. This is critical to ensure that your returns are processed through these special procedures. Next, complete and sign a statement on Form 14654, and if you click this link, it'll take you to that form on the IRS website, certifying that you are eligible for the streamlined domestic procedures, that all required FBARs have now been filed. And so in other words, to take part in these streamlined procedures, you need to file the delinquent FBAR reports and then file the streamlined procedure application. And that the failure to report all income, pay all tax, and submit all required information returns, including FBARs, resulted from non-willful conduct, and that the miscellaneous offshore penalty amount is accurate. With respect to the certified statement, you must maintain records of your foreign financial assets which support how you computed the penalty and be prepared to provide them on request. You must also submit an original signed statement and attach copies of the statement to each tax return and information return being submitted through these procedures. And you should not attach copies of these statements, though, to the FBARs because those are filed electronically. Failure to submit the statement or submission of an incomplete or otherwise deficient statement will result in the returns being processed in the normal course without the benefit of the favorable terms of these procedures. Submit payment of all tax due as reflected on the amended tax returns and all applicable statutory interest with respect to each of the late payment amounts. Your taxpayer identification number must be included on your check, and you may receive a balance due notice or a refund if the tax or interest is not calculated correctly. In terms of calculating the interest on the tax correctly, that one may not be super easy. I'm not necessarily wonderful at that type of calculation, but I did find a website that calculates your IRS interest for you, and I use that, and hopefully they'll be close. Submit payment of Title 26 miscellaneous offshore penalty as defined above. And if you seek relief for failure to timely elect deferral of income from certain retirement or savings plan where deferral is permitted by an applicable treaty, submit a statement requesting an extension of time to make an election to defer income tax and identifying the applicable treaty position. A dated statement signed by you under penalties of perjury describing the events that led to the failure to make the election, the events that led to the discovery of the failure, and if you relied on a professional advisor, the nature of the advisor's engagement and responsibilities, and for relevant Canadian plans, a Form 8891 for each tax year and each plan and a description of the type of plan covered by the submission. The documents listed above, together with the payments described above, must be sent in paper form. Electronic submissions will not be accepted, and they need to go to this specific address, Attention Streamlined Domestic Offshore in Austin, Texas. This address may be used only for returns filed under these procedures, and for all future filings, you file according to the regular filing procedures. For each of the most recent 6 years for which FBAR due date has passed, file delinquent FBARs according to the FBAR instructions and include a statement explaining that the FBARs are being filed as a part of the streamlined compliance procedures. You are required to file these delinquent FBARs electronically at FinCEN. When you are on the FinCEN site filling out the electronic format of the form, on the cover page of that electronic form, there is a drop-down menu for the reason for late filing, and you click on that drop-down menu, select option other, and then in the space provided, type streamlined filing compliance procedures. If you are having trouble filing those FinCENs electronically, there are some helplines here. So continuing on with our illustration for Keiko Ono, she submitted Form 14654, certification by a U.S. person residing in the United States, and earlier in the year she filed her timely 2014 individual and FBAR returns that properly reported her worldwide income. Though under the procedures, she's supposed to file amended returns for the most recent 3 years. So the only thing I can figure is that even though 2014 was correct, she still needs to submit an amended 2014, and obviously nothing's changed, so the balance due with 14 will be 0. And then on 2013, she's going to add in the offshore income and figure the tax she owes. In 2012, the same thing, figure the tax she owes. She needs to figure the interest she owes and then tally it all up and put it on the offshore compliance form, this 14654. But first, I did want to show you this front page of the report of foreign bank accounts and financial accounts. You can see here it says filing name. I've given it a filing name of Keiko Ono. This is literally the front page of the form. It asks, if this form is being filed late, select the reason for filing late. I selected other, and then in the explanation section here, I typed streamlined filing compliance procedures. And then we go on to complete her Form 14654 as shown next. And on this form, we're showing the most recent years for which the filing deadline has passed. That's 14, 13, and 12. Keiko did not apply for an extension, so that doesn't apply to her. Therefore, it's 14, 13, and 12. On this column right here, she's showing the amount of tax shown on line 19 of her 1040X for each year. Line 19 of the 2014 1040X is 0. Line 19 for 2013 is $2,000, and line 19 for 2012 is $1,000. The total tax due is $3,000. We figured interest owed on those years, and included that in. So the total amount of tax that she owes and interest that she owes is $31.50. We then go down year by year and list her foreign financial assets. The instructions say if you have more accounts than there's space for that you should attach a statement, but I kept it small at just 2 accounts. And you can see that there's fluctuations in the value of these accounts. In 2013, they totaled $600,000. And 2012, they totaled $640,000. Well, 2012 is actually the maximum year, and so her offshore penalty is going to be based on 2012. So we've got 2013, $600,000, 2012, $640,000. We go to 2011, it was $610,000, and this earlier years we had $560,000, $530,000, $520,000. But at any rate, the high year here is $640,000, 2012. So that's the year the penalty will be based on. And we're only filing 6 years of delinquent FBARs. All of the other years were timely filed. So we're done with the FBAR information. And now we go over to calculate the penalty. And we're going to take the highest year, 2012, the highest balance, $640,000. Multiply that by 5%, we get $32,000. We add in the total tax and interest due on the amended returns. And we total those numbers up and we get $35,150. And this is the amount that Keiko Ono is going to need to pay with this application. We're not done. We need to type up a statement, and the instructions say that this statement must also be attached to each and every one of the 1040X returns. So we've included it actually on the form, but we should also include the statement and attach it to the amended returns that are being filed. Just a note here that taxpayers who are under examination are not eligible. If the IRS has initiated a civil examination of the taxpayer's returns for any taxable year, regardless of whether the examination relates to undisclosed financial assets, the taxpayer will not be eligible to use these streamlined procedures. Similarly, a taxpayer under criminal investigation is also ineligible. Willful violators should still use the Offshore Voluntary Disclosure Program and not these streamlined procedures. For more information, there is a FAQ page at IRS, and I've got a link in here for that, and then, of course, another link for the non-resident procedures. All right, so the next thing we're going to talk about is the Foreign Account Tax Compliance Act, or FATCA. And there's the FBAR requirements and there's the FATCA requirements, and most of the rules for them seem very similar, but ultimately they have differences between them. And FATCA came into effect a few years in the past. It's been around since I think about 2010. On November 8, 2012, the U.S. Department of the Treasury announced that it had engaged with more than 50 countries and jurisdictions around the world to improve international tax compliance and eliminate the information reporting and withholding tax provisions and implement the information reporting and tax compliance procedures that are commonly known as FATCA. For more information about FATCA and these regulations, you can click on the link I've shown here. So what types of assets are includable on Form 8938? We've got a list of things here, and either yes or no next to each. Firstly, financial deposits and custodial accounts, they need to be reported. Financial account held at a foreign branch of a U.S. financial institution, no, but yes on FBAR. Financial account held at a U.S. branch of a foreign financial institution, no. Foreign financial account or asset for which you have signature authority, no. Then we move on to foreign stock or securities held in a financial account at a foreign institution. The account itself is subject to reporting, but the contents, the individual contents, do not have to be separately reported. So we go on and it lists all of the things that fall under the filing requirements for FATCA. So some things are reportable under FATCA that are not reportable under FBAR, and some things are reportable under FBAR that are not reported under FATCA. So it can be confusing, but for the most part, they're very similar. So who is required to attach Form 8938 to their tax return? IRS says you are required to file Form 8938 if you are a specified individual, and currently a specified individual is a U.S. citizen, also a resident alien of the United States, a non-resident alien who makes election to be treated as a resident alien, and a non-resident alien who is a bona fide resident of American Samoa or Puerto Rico. And you have an interest in a foreign financial asset required to be reported. And a specified foreign financial asset is any financial account maintained by a foreign financial institution or other foreign financial assets held for investment that are not an account maintained by a U.S. foreign financial institution, such as stocks or securities, any interest in a foreign entity, and any financial instrument or contract that has an issuer counterparty that is not a U.S. person. And also, the aggregate fair market value of your specified foreign financial assets is more than the reporting thresholds that apply to you. So these are the three requirements if you meet 1, 2, and 3. And 3 is this table, meaning do your assets total more than these amounts, then you have to file Form 8938. And you can see that these amounts are significantly higher than they are under FBAR. Interestingly, the taxpayer advocate, one of her criticisms of FBAR is she feels the numbers on it are too low, that if we've got $50,000 as the filing threshold under 8938 and FATCA, why is it only $10,000 under FBAR? But as it is, we do have two different filing thresholds to be concerned about. And under FATCA, if you are not married and you live inside of the United States, the filing threshold for Form 8938 is $50,000. So let's just suppose you own a corporation overseas. You own a corporation valued at $100,000. Well, that corporation, the ownership you have in it, is not reportable under FBAR. It would not go on the FBAR report that you file with FinCEN. But it is reportable under FATCA, and you would need to report it on Form 8938. Now, if you live in a foreign country, however, the filing thresholds quadruple. So if you live in a foreign nation and you own a corporation valued at $100,000, you wouldn't need to file Form 8938 with your American return because it's less than the filing threshold for a person living abroad. Now, the filing thresholds for married persons are essentially twice that of single persons, and married filing separate is the same as single. Here is Form 8938. You can see that on Form 8938, it asks you to indicate the number of foreign accounts that you are reporting information on. You divide them into foreign financial assets and other foreign assets. And essentially, foreign deposit and custodial accounts would include foreign pensions. They'll include foreign brokerage accounts, foreign bank accounts, and other foreign assets would be, say, direct ownership in stock that is not done through a brokerage firm. There's other illustrations as well, and you can read the instructions on those. We then enter the amount of income you have from your foreign financial accounts, and you indicate what form or schedule the income is being reported on, how much income that is. So you've got the form line, which typically I would say Form 1040, line 8. And the schedule would be Schedule B, line 1, if it was interest. And then I would indicate the amount of interest income that I've received from those foreign financial assets. And you do that for each type of foreign financial asset that you have. Now, if you are reporting income or ownership of foreign financial assets on another form, such as 3520 or 8891, you do not also need to report it on Form 8938. And so if that's the case, you would indicate how many of these other forms you filed instead. We then get down into Part 5, where you enter detailed information for each of the foreign deposit and custodial accounts. You indicate what kind of account it is, the account number, whether you opened or closed the account during the year, and whether you hold it jointly with a spouse. And then the maximum value of the account during the year. Did you use a foreign currency exchange to convert the value of the account into U.S. dollars, yes or no? And if you answered yes, then it wants to know the foreign currency in which the account is maintained, the foreign exchange rate that you used, and if you used a source other than the U.S. Treasury Financial Management Service, what source did you use to come up with your exchange rate? And then we move on to subsequent pages of the report where if you are reporting stock, for example, because this top part here is for foreign financial accounts, if you have stock or other types of assets that you need to report on here, you report it in a different section and you indicate, rather than indicating an exact value, you indicate a range of value for that asset. Duplicate reporting requirements, as I've said, because FBAR and FATCA have different reporting requirements, it is often the case that you have to do both, and that gets to be pretty arduous when you're doing both. It's really time-consuming. Filling out Form 8938 is time-consuming, and filling out FBAR is time-consuming. Filing them separately is time-consuming. So clients of mine, I have one client, he's from France. He'd be a 1040A filer, literally. His W-2 income is high enough that he ends up filing 1040, but he doesn't even itemize. His tax return is so super simple. but I still have to spend a great deal of time on his return and charge him a high fee because he has these foreign financial accounts, and it just takes a certain amount of effort to go through all of that. IRS has simplified procedures for favorable tax treatment on Canadian retirement plans and annual reporting requirements. Late in 2014, the IRS issued Internal Revenue Bulletin 2014-97, which provides the following benefits to taxpayers who hold interest in these foreign financial accounts. I'm going to talk a little bit about Canadian plans. Essentially, if you have an investment in a Canadian RRSP, which is similar to an IRA, historically, you could elect to get treatment on that RRSP that was the equivalent of IRA treatment here in the United States, and you did so by filing Form 8891. The thing was that most people who had these RRSPs didn't know they needed to, so then the IRS had all these procedures in place for asking for relief and filing it late. And finally, they said, to heck with it. It's automatic and you don't need to file the form anymore. So people who have Canadian retirement plans really are the only ones who have an easy go of it. They still need to report the Canadian plans on FBAR and under FATCA. It's not an elimination of that requirement, but what it is an elimination of the requirement to file Form 8891 to ask for tax treaty treatment that allows you to defer income on your Canadian retirement accounts. Now, that doesn't cause any relief for people who are from other countries and have retirement accounts in other nations. That's still another complex issue, but at least if you're dealing with a Canadian, you've got it easy. 8891 still exists because if you put money into an RRSP or you take money out of an RRSP, the IRS still wants to know about it, but the annual requirement to just report your existing balances in the Canadian account is no longer there. And IRS said initially that it was doing away with the form completely, so I thought it was going to be gone. And then all of a sudden they didn't get rid of it, and it's still being used for people who put money in or take money out. Go figure. All right, and we're on to the final brief topic of the day, which is to look at flow-through income that comes to you on a K-1 from a partnership, S corporation, trust, or estate. Generally, partnerships and S corporations are not taxable entities, and the income gains, losses, and credits that come to you from these entities are going to flow onto your personal return, and they must retain their character. So interest income is treated as interest income, dividend income is treated as dividend income, rent income is treated as rent income. They aren't all lumped together and given the same type of treatment. They all retain their separate character as they flow through to you. If you are responsible for reporting your share of income from an estate, partnership, trust, or S corporation, you will receive a K-1. And the K-1 is the document that you will then use to prepare the return for the person who received it. And to really show you more about how that works, I have a classwork assignment. And the classwork assignment involves a character named Jerry McGuire, who is an investment broker. And in addition to receiving a consolidated statement from Dux Bank, Jerry had an investment interest from an investment account he holds with the Royal Bank of Canada. The interest he earned for the year was $700 Canadian, and the exchange rate is 1.07 Canadian to the US dollar. His highest balance in the account for the year was 55,000 Canadian. The account is in Calgary at this address. Jerry also received a K-1 showing his share of income from Gridirons Inc., which is an S corporation in which he is an active participant. Jerry's tax documents are attached to prepare his federal return and his FBAR. So we're going to do both of those for you. You can see his W-2 shows 85,000 of income, 12,750 of withholding. We then have his consolidated 1099 statement. You will see it shows box 1 interest of $1,300, savings bond interest in box 3 of $250, and he has tax-exempt interest of $1,500. The same consolidated statement shows that he has $500 of ordinary dividends. And when we move down to the summary of interest, it just shows a breakdown of when he received those interest payments and dividend payments. And those can be helpful if you look on these supplementary pages of these brokerage account statements. It can be helpful if you're trying to break down income for people who've moved during the year from one state to another so that you can allocate income to the correct state. Here is the K-1. And when we look at the K-1, we're interested in the type of income being reported on it. Firstly, we see ordinary income. And when I see $1,600 on line 1 of a K-1, I'm thinking that's going to carry to line 17 of the 1040, and it's going to be reported on Schedule E, page 2. Then when I look farther down, I see there's also $100,000 of interest income. And I know that this interest income is going to retain its character, and therefore it will not go on Schedule E, page 2. Instead, it's going to carry to Schedule B if Schedule B is required, and then on to the Form 1040 on line 8A. And we can see that there's a Section 179 deduction down here on line 11. That Section 179 deduction is going to be claimed on Schedule E, page 2. It is an offset to the income on line 1. So mentally, I know I'm going to take $400, subtract that from $1,600, and the net is actually going to be taxable. And I've enclosed a copy of page 2 of Schedule K1. The Schedule K1 instructions, or this particular page of Schedule K1, is just used to help to identify the meaning of any codes you see on here. And you can see we have a code A on line 17, other information. What does that mean? Well, you follow it down and it says investment income. If you are claiming investment interest expenses, you would report investment income shown on line 17 with a code A on Form 4952, line 4A. And of course, any other amounts appearing on this document here, like line 4 says $1,000. We go down here and it says interest income, carry that to Form 1040, line 8A. So I kind of know in my head what these instructions are already, but if you don't, then you look at the instructions here. So let's take a look at the finished answer key for this problem. This actually is not that complicated a tax return, but you're going to see by the time we're done, it is complicated because of all of the foreign financial account disclosure issues that we have to deal with on it. I'm going to quickly scroll down to the finished forms. The first 2 pages are really a description of what's going on and why, and then we actually have a printout of the return itself. And you can see on line 7 we've entered his wage. On line 8A we've reported all of his income from interest, including the Canadian interest, the interest flowing through on the K1, and the tax-exempt interest that's showing on his 1099 DIV and 1099 INT statements. And then, of course, we have dividend income of $500. And then remember when I was looking at the Schedule K1, I said, look, he's got this Section 179 deduction down here, and he's got this ordinary income amount up here. We're going to offset those, and the total will be $1,200. And so the number that I'm expecting to see on line 17 is correct. It's $1,200. We then move over to page 2 of the form. And we're calculating his tax, showing his withholding, and you can see he's got a $3,050 refund. None of that's terribly exciting. It's what else goes on the other forms that is of interest. And so the first form we've got here is the Schedule B, and on it we're going to show Ducks Bank, for which he received a 1099 INT. We're also going to show Gridirons Inc., because that was the flow-through from the K1. And then we're going to show the interest coming through from the Royal Bank of Canada. Well, remember we showed that the interest paid was Canadian interest, Canadian dollars. Well, we're going to have to apply the conversion rate to come up with the US dollar amount, and we came up with $654. And then we show Cleats Inc. as paying out the $500 of dividend income. And on the Part 3 of his Schedule B, we show that he has ownership or control over a foreign financial account. He is required to file FBAR, yes. The country in which that account is located is Canada, so we've typed in Canada. We then move on to Form 8938, and on Form 8938, we indicate that the foreign interest that he has is $654. That's been reported on Form 1040, line 8A, and on Schedule B, line 1. And then we indicate his ownership of the account. We say it's a deposit account. We show the account number. We show the highest balance in that account in US dollars. We indicate the foreign currency in which that account is maintained and the foreign currency exchange rate used to convert to US dollars. We then move over to enter the address of the institution and the country as well. So you can see the zip code for Canada there. We move then on to Schedule E, page 2, and on Schedule E, page 2, we indicate that the entity from which the K1 came was Gridirons Inc., and it is an S corporation. We enter the EIN of the S corporation. We show the amount of Section 179 expense flowing through, $400, and we show the income at $1,600. I want to point out that there are 2 columns here, passive income and loss and non-passive income and loss. And we get into this more when we're looking at rental income and also passive activity loss limits and at-risk limits. Those courses are coming up later in our spring series. And then in June, I'm going to teach my course called Introduction to S Corporations and LLCs. And in those courses, we look more at the concept of passive versus non-passive. But essentially, non-passive is the same as active. They should, in my mind, have a description that's passive. I'm just there. I'm not doing anything. And the opposite of that being active, I'm engaged in this business. But rather than doing that, IRS says you're passive. That means you have no involvement in the operations of the business, or almost no involvement, versus non-passive, where you are actively engaged in your business. In the case of Jerry Maguire, he's actively engaged in his business, so the amounts flowing through from the K-1 go in the non-passive columns. If he were passive in his business, he would report those in the passive columns. And the reason we care is that when you have passive losses, those losses cannot be used to offset anything other than passive income, whereas non-passive losses are allowed to offset other forms of non-passive income. So anyway, we enter the $1,600 of ordinary income, the $400 of Section 179 deduction. We total those up and we get $1,200. $1,200 then carries to the 1040. He also has to attach a depreciation schedule, which he uses to claim the Section 179 deduction, and that is calculated on Form 4562. And then we have his FBAR report. His FBAR report is timely filed, so we aren't providing an excuse for late filing. And on the FBAR report, we're essentially reporting all of the same information in pretty much the same way that we reported on his FATCA form. And that's where the taxpayer advocate is saying there's a lot of duplication. And I agree, there is a ton of duplication. It's the same information, two different ways and two different very time-consuming methods. But here they are. So we have the information on his Canadian account. And essentially, when you're filling out these FBAR reports, there is a button right here you can see where you click plus or minus to add or delete additional accounts. And so if you had more than one account, I'd click the plus symbol and it would give me another drop down to continue going. So that's it. We are done with today's class. Thanks for participating. Hopefully you learned something new and useful. And thank you for participating in today's training program. I hope to see you again soon. Password number 2 is Cisco. S-I-S-K-O. Cisco. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.